Hey everyone, if you have a foundation in the DIFC or ADGM or intend to set up one, then this video is for you. Many believe that if you have a foundation, then the UAE corporate tax law assumes that there will be no tax. This is absolutely false. The FTA considers 5 conditions that need to be met for a foundation to be considered as tax-free, or rather as a flow-through entity. Before we dive in, a quick disclaimer. This video is for educational purposes only. Do not treat this as professional or legal advice. If you find value in content like this, please subscribe to get regular insights on information tailored to business owners, CEOs, CFOs, and aspiring leaders. Now let's get back to the video. Here's why this is important. If the foundation meets all 5 conditions stated by the FTA and makes an application to the Federal Tax Authority, then the FTA may consider the foundation to be fiscally transparent and pays 0% tax. The foundation's income then flows through directly to the beneficiaries. The beneficiaries, being natural persons, will not have to pay any tax on its investment income and personal real estate income. However, if the foundation do not meet any of these 5 conditions or forgets to make the application to the FTA, then by default the foundation will be considered taxed at 9%. So what are the 5 conditions? Let's go through them. Condition 1 is the beneficiary condition. The foundation must have been set up for identified or identifiable natural persons, your family members, or for public benefit purposes like a charity, or both. If your foundation was set up for corporate shareholders or commercial purposes, it will not qualify. Condition 2, the principal activity condition. The foundation's main activity must be to receive, hold, invest, or manage assets related to savings and investments. Holding a holdco, owning real estate, receiving dividends is all fine. Condition 3, there is no business activity. This is the one that catches most structures, and we'll discuss this in detail in a little bit later. Condition 4, the foundation's principal purpose must not be avoidance of corporate tax. Importantly, the FTA's own guidance states that applying for fiscal transparency is not by itself considered as tax avoidance. It's just legitimate estate planning. Condition 5. This condition applies only when one of your beneficiaries is a charity or a public benefit entity. There's a specific 6-month distribution rule. Again, I'll cover this separately in this video. Condition 3 is where I see most businesses failing. The FTA does not ask if the foundation has a license. Rather, it asks if the beneficiaries did this activity by themselves, ignoring the foundation. Would they have to get a license to do this? Holding shares and receiving dividends is not business. Renting out a residential apartment without a license is not business. These pass. Operating a hotel, running a serviced apartment, providing advisory services, those would require a license if done personally. The foundation fails on those activities. Now it's also important to note that owning a company that conducts businesses is not the same as conducting the business yourself. The foundation holding shares in an operating company is fine at the foundation level. The operating company is a separate taxable person. The foundation just holds shares passively. If your foundation has a charity or a public benefit entity as a beneficiary, then condition 5 kicks in. Here, there's a hard 6-month deadline. If the income earned would be taxable in the hand of the beneficiary, then this income must be distributed to the public benefit entity within 6 months of the year end. So if the foundation's year end is December, then by June of the next year, this income must be distributed. If you miss this deadline, it's not just that specific distributable income that will be taxed, but the entire foundation will be considered as taxable. Let me now clarify the difference between being transparent and not transparent. If the foundation is considered transparent, then the beneficiaries are also considered transparent because they're natural persons. We've discussed this earlier. And the holding companies below the foundation will also achieve the same status. On the flip side, if the foundation is not considered transparent, then the foundation will pay 9% at
the corporate tax level, and all the holding companies below it will also not achieve the transparency status. So the chain is broken from the top. So how do you achieve this transparency status? There are two steps. First, register the foundation for corporate tax with the FTA through the Amara tax portal. You must register before you can apply for the transparency. This applies even if you ultimately won't be paying any tax. Second, submit a separate application to be treated as an unincorporated partnership under Article 17. That application must be made before the end of the tax period. One important point to note is that there is no backdating. The transparency treatment only takes effect from the tax period in which you apply. Every tax period you leave without an approved application is a period your foundation is potentially a taxable person. I hope this video gave you a better understanding about foundations and how they can be a transparent and tax-free entity for you.
You've reached the end of this video. Thank you for listening. If you like this content, please hit the like button and subscribe to our channel. If there are any specific topics you want us to talk about, please let us know in the comment section below.